Most Canadians never think about the document that quietly governs every interest rate decision in this country, the Monetary Policy Framework. But the Bank of Canada just published a report on what Canadians told it when it asked a simple but loaded question: are we doing this right? That question has enormous consequences for your mortgage payment, the price of groceries, and whether you can afford to save. Today we unpack what this consultation means and why the answer matters far more than most people realize. The Monetary Policy Framework is essentially the Bank of Canada's operating manual. It defines the goal the bank is trying to hit, currently, keeping inflation at 2%, the midpoint of a 1 to 3% target band, and it outlines how aggressively the bank should act when inflation drifts away from that target. Every rate hike and every rate cut you have lived through flows directly from this document. It is renewed roughly every 5 years in an agreement with the federal government, making this consultation a pivotal moment in Canadian economic governance. The bank chose to consult now because the last framework renewal in 2021 happened just before Canada experienced its worst inflation surge in 4 decades. That surge, and the aggressive rate hike cycle that followed, left a lot of Canadians asking hard questions about whether the framework itself was fit for purpose. Conducting public consultations in the aftermath of that experience means the feedback the bank collected is not abstract or academic. It is grounded in lived financial pain. The consultation was deliberately broad. The bank gathered input from economists, financial institutions, business groups, academics, and members of the general public. That breadth matters because the framework affects different groups in very different ways. A homeowner with a variable rate mortgage experiences monetary policy very differently than a retiree living on fixed income, or a small business owner trying to plan a payroll. Pulling those perspectives together into a single report is itself a signal that the bank is taking the legitimacy of its decision seriously. The central tension in any monetary policy framework debate is this: how much flexibility should a central bank have, and how much should it be locked into a rigid, predictable rule? A strict inflation target gives businesses and households a reliable anchor. They can plan because they trust the bank will always chase 2%. But rigid rules can cause a central bank to raise rates aggressively even when doing so crushes jobs and housing markets, because the rulebook says inflation is the only thing that counts. This is the tension that likely dominated the consultation feedback. While the bank has not released the granular details of every submission, consultations of this type typically surface a clear pattern, and the timing here tells us something. The rate hike cycle that ran from early 2022 into 2023 pushed the overnight rate to levels not seen in over 2 decades. Mortgage renewals became a genuine financial shock for hundreds of thousands of Canadian households. It would be reasonable to infer that a significant portion of public feedback reflected that experience and asked whether the bank moved too aggressively, or whether it should weigh employment and housing affordability more explicitly alongside inflation. One of the most technically significant questions any framework consultation raises is whether 2% is still the right inflation target. Some economists have argued for a higher target, say 3%, which would give the bank more room to cut rates in a recession before hitting the zero lower bound. Others argue the 2% target is a hard-won credibility anchor that should not be touched. What the bank chooses here shapes the entire interest rate environment Canadians will live in for the next 5 years. Even a subtle shift in how the target is defined or weighted can ripple through mortgage rates, bond markets, and household budgets. A persistent question in Canadian economic circles is whether the Bank of Canada should formally expand its mandate to include employment or housing affordability alongside inflation. Right now, the framework focuses on price stability as the primary goal, with the understanding that stable prices eventually support employment. But the last few years exposed how brutally that sequencing can work against ordinary Canadians in the short run. Rates rise to kill inflation, and housing costs and job losses follow. Whether the consultation feedback pushes toward a more dual mandate, similar in spirit to what the U.S. Federal Reserve operates under, is one of the most consequential questions this report raises. It is worth being clear about what is unlikely to change dramatically. The Bank of Canada's independence and its core commitment to price stability are deeply embedded in Canadian financial credibility. Bond markets, foreign investors, and trading partners all price Canadian assets partly on the assumption that the bank will keep inflation anchored. Any framework that appeared to subordinate price stability to short-term political pressures would risk a serious loss of confidence, and that would ultimately hurt the Canadians it was meant to help, through higher borrowing costs and a weaker dollar. Change in a central bank framework is almost always evolutionary, not revolutionary. Here is the direct line to your life. The framework determines how quickly the bank raises rates when inflation rises, and how quickly it cuts when the economy slows. If the new framework allows more patience before hiking, giving the labor market more time to recover, for example, variable mortgage holders get a smoother ride. If the framework becomes more aggressive on inflation, fixed mortgage rates stay elevated longer. If the bank is given a softer inflation target, the purchasing power of your savings erodes a little faster over time. None of this is abstract, it is the arithmetic of your financial life, decided in a document most Canadians have never read. The framework renewal agreement between the Bank of Canada and the federal government is what transforms this consultation report from interesting reading into binding policy. Watch for the timing and language of that renewal announcement, specifically whether the inflation target band is adjusted, whether any employment or housing language appears in the mandate description, and whether the bank signals more or less tolerance for inflation running above 2% during recovery periods. Any of those details will tell you more about the next 5 years of Canadian interest rates than any single rate decision announcement. The Bank of Canada asking Canadians what they think about monetary policy is not a routine administrative exercise. It is a rare moment of institutional self-reflection after a period of genuine economic turbulence, and what comes out of it will govern the interest rate environment for the better part of the rest of this decade. Understanding the framework is how you move from reacting to rate decisions to anticipating them. If this kind of deep Canadian economic analysis is useful to you, consider subscribing. We cover the numbers and the systems behind them, every week, without the noise.